Look closely at a $100 bill. It is essentially a piece of linen and cotton covered in green ink. It has no practical utility in nature. You cannot eat it or build shelter with it. Yet we participate in a global system built entirely on the shared belief that this paper holds power. This is the core of perceived value. A common rock has no societal worth, but a rare, shiny rock like gold is assigned a high price. Gold isn't inherently more useful than gravel. It's simply more valuable to humans because we have agreed its scarcity makes it so. To acquire massive amounts of this constructed value, you must provide something society deems more valuable. When Steve Jobs revealed the iPhone, he introduced a tool so transformative that millions of people were willing to trade thousands of dollars for a single device. For most people, wealth starts by trading finite time for a paycheck. You swap hours of your life for a set amount of currency, but as soon as that value is in your hands, the struggle to keep it begins. Even before your earnings reach your bank account, invisible forces begin to dissolve them. You might earn $2,000 for a month of work, but the amount that actually hits your balance is significantly lower. These are taxes, the baseline cost of maintaining a civilization. Your income is hit first, then sales tax when you spend, and capital gains on your investments. These percentages fund everything from the roads you drive on to social safety nets like Medicare and Social Security. Beyond taxes lies a second, more quiet force: inflation. This is the gradual erosion of what your money can actually buy. Over time, the $5 bill in your pocket remains a $5 bill, but its ability to purchase gas or groceries slowly diminishes. Inflation often occurs when too much money chases too few goods. If 2,000 people want to buy the same television, but only 1,000 are available, the business increases the price. Your money hasn't changed, but its relative value in the marketplace has dropped. Because of these combined forces, hoarding cash in a shoebox results in a predictable mathematical loss of wealth. To protect your earnings, you are forced to move them into the broader financial machinery of the banking system. Most people view a bank as a high-security warehouse where their specific dollars sit in a vault, guarded and idle. In reality, the moment you walk out the door, that money is gone. Banks act as matchmakers through fractional reserve banking. If you deposit $1,000, the bank keeps only a small fraction on hand. They immediately lend the other $900 to someone else at a higher interest rate to fund a car or a business. This system is built entirely on the assumption that every depositor will not demand their cash back at the same time. The bank only has a fraction of the total deposits available as physical currency at any given moment. We saw the consequences of this in 2008, when collective trust in the system vanished. People lined up to withdraw their entire accounts at once. Because the banks had already lent that money out, the machinery began to collapse. The financial system treats your money as a supply to meet a borrower's demand. It is a system designed to reward capital that is active and moving, rather than capital that is stagnant. To participate in the borrowing side of this machine, you must be vetted by a credit score. This is an algorithm that tracks your financial history to determine how much a lender can trust you. The score looks at your payment history and how much of your available credit you use. Below 580, you are considered a high-risk borrower. Above 750, you gain the credibility needed to access the lowest interest rates on houses and cars. Even with a perfect score, the system periodically undergoes a recession, a period where the economy shrinks for at least 6 months. During these resets, jobs are often cut, and spending shifts strictly to necessities. To fight these downturns or combat high inflation, governments manipulate interest rates. By raising the cost of borrowing, they make it more expensive to get a loan, which reduces spending and cools down an overheating economy. If you operate only as a consumer, you remain at the mercy of these economic cycles and algorithms. To move ahead, you have to transition from being a source of supply for the banks to being a collector of interest yourself. Interest is simply the rent that money charges to exist in someone else's hands. When you borrow, interest is a price tag. When you save or invest, interest is your reward for being patient. On a credit card with a 20% interest rate, A missed payment means your interest begins earning its own interest. In this exact scenario, a $12 burrito can quickly turn into a $50 debt as the balance compounds against you. But as an investor, this math works in your favor. At a 7% return, $100 becomes $200, then $400. You access this growth through stocks, company ownership, bonds, loans, and real estate, allowing your capital to outpace inflation. The most critical factor in this process is not the size of your paycheck, but the amount of time you allow the math to work. True wealth isn't built through luck or high-risk gambling. Instead, it is built over decades of consistent, patient compounding. Financial independence is the result of understanding these rules. By stopping the erosion of your money and giving it the decades it needs to multiply, you eventually reach a point where your capital, not your labor, buys back your time.